Hello traders, and it's Thiru Nagappan here, founder of Master of the Markets, Illustrious Conference and Traders Open Day. Actually sitting in that room with that guy who showed you all the charts of price bars and your DBS, and you got to meet that guy and he triggered your interest with his red Jaguar, and then now you are here today, in trading and
That's right, yeah. And when I gave up my job, I was head of research at De Beers, and when I gave up my job to trade full time, my poor mother had a heart attack. We had to hospitalize her. She she was very upset that I gave up a really good job to, in fact, become a full time trader. And clearly it's difficult. I don't care how long you've been trading. When you start to trade and you haven't got a full-time income, it puts a great deal of pressure. Many of the people listening will have read Reminiscences of a Stock Operator, and folks, if you're listening and you haven't,
yes.
you need to find a copy of it.
It's a really good book, a very good book.
Old Livermore himself wanted to buy his wife a fur coat, and in one of the chapters he traded for many months on end, and he still couldn't afford the price of the fur coat. And he said that if you need a coat badly, the stock market won't give it to you. Okay, so scared money is quite difficult. It takes a while to get over that. And I know many people who've never been able to get over that. They trade really well when they've got an income, and when that's solid income or guaranteed income goes away, then they start to do stupid things. And I can understand that. Not easy at all. Took me a while to get used to it.
Makes sense. I guess it just takes a while for the mind to get in gear. I think we've all gone through that. We can totally relate to what you're saying.
Yes, it requires what I call testicular fortitude.
All right, nice way of
Yes.
putting it. Now,
Testicular
going on into
fortitude.
the just a little bit more technical questions before we go onto the screens, if we may. So the first question to start off that I just want to ask you, what is your main style of trading? Like, are you a swing trader, scalp trader, position trader? Do you mainly do intraday trading? What is it?
I've been a swing trader most of my life, but I still do some intraday trading. I was yesterday afternoon, for example, on the Dow, what the local spread bettors in London call Wall Street. I had 3 trades, so I don't intraday trade every day, but some days I will in the afternoon, mostly in the Dow in the afternoon. It opens at 2:30 here in the UK. And if I see an opportunity, I'll certainly trade that in the afternoon. But my main style of investing and trading is as a swing trader. And I have a slide prepared that will show everybody in a second what I actually do and the philosophy behind what I try and do. It's actually quite simple. I have 4 rules that I do my best to put into practice. The Vectorvest people, I see quite a few of them in the room, will have heard them. I do a weekly webcast to everybody, and I do my best to try and reinforce that thinking every Monday afternoon. Whether you're trading in the stock market, whether you're trading in forex, we only can make money by finding some form of a trend and then doing our best to finesse an elegant entry into that trend where the risk is least and the reward is most. And that's what I specialize in doing. So I am a trend follower. I look for trends, but I'm very careful about entry points because I like to get in at what I call the danger point, where, as I say, the risk is small and the reward is huge. And in this journey over the since 1982, without a doubt, the most important thing to our profitability, in my humble opinion anyway, is to try and maximize that risk to reward ratio, more correctly reward to risk ratio. But on a trading floor, it's called risk to reward. If you called it reward to risk, they would think you were a child of a lesser god. So try to push that up as high as possible. Most of us, I don't care how long we've been at this, find it quite difficult to put into practice a low hit rate system. If you're only right 5 times out of 10, which is common in a trend following system, that means that in the probability of having 2 bad ones in a row is a half times a half.
Yes.
The probability of having 5 bad ones in a row is a half times a half times a half times a half times a half, which is 1/32. And that means that in a trend following system, and a trend following system, if you're right 5 times out of 10, you're doing well. You can have 5 losers in a row every 32 trades. You have to say to yourself, how good would you be at focusing on perfect execution of your rules after 5 losers in a row? That's the challenge for most people. In my trading seminars, I spend a very long time talking about clustering. And those clusters are real, folks. If you don't believe those clusters exist, just as I say, have a little go at it. The clusters.
We definitely agree with you on that, David. We've definitely experienced, all of us have. Yeah, carry on, yes.
Good clusters of good trades and bad trades. The first thing is to get over the clusters mathematically, i.e. don't go broke in them, which means the old story of risking 1 or 2% in any one trade. And then, of course, the other thing is to be able to handle the clusters emotionally, so that you don't fall apart after 2 or 3 losers. And that takes, as I say, a great deal of testicular fortitude to do that. So the clusters make this game hell. That's why the stock market's a lot easier, because by only applying what I do to shares with outstanding fundamentals, when the overall market is rising, I can push that hit rate up significantly from the 50%. And when the hit rate rises, then the clusters, the probability of a run of bad ones disappears. It's still there, but it doesn't happen nearly as often, which means emotionally it's much, much easier to trade. So the first thing,
David. Yeah, the most important thing is the emotional part, isn't it, for you to move forward with it?
Yeah, that's for sure. That is for sure.
Just a very quick questions before we go on the screen. Just so need to pace ourselves properly, because I think the time as well. Just a quick thing, like just some quick questions, based some quick answers would be great before we go on the screens. And I'm sure you're going to go in detail about your strategies. Just on entry itself, is there like a concept that you have to all your trade setups that you take?
Yes. Is that short enough?
Maybe a little bit more, a few words more. I'm sure you explain more in detail later on. But anyway,
I will, but it's something that I can explain very, very easily in a slide.
Okay, never mind. So we'll leave it to later.
I'm going to faff to actually explain it without. And those of you that have come to my seminars will know that I normally sketch everything up on a flip chart so everybody can see it while I'm speaking. There's nothing complicated about it, but it's difficult to do, and that is one of the characteristics of a good trade, which I'll talk about in a second.
Okay, no problems. Yeah, I think the next one is similar to that, so I guess you will explain that. I was asking more like, what does your typical trade entry look like? So you will show that anyway, right? On your slides,
sure,
anyway.
Without a doubt. Yeah.
Okay. Do you scale into trades?
Yep.
Yes, you do. Okay. And what is your best trade to date so far? And what was your thinking behind the entry?
Well, the entry is always the same. The entry is always the same. And I think that one of the things that you have to really do your best. It's one of the biggest behavioral investing mistakes. And that's all about separating the process from the result. Now, if I stand up at a seminar and I ask that question you've just asked me, invariably everybody will tell about the trade that made them the most money. And if I ask them, what was your worst trade in the last 3 months, they'll tell me all about the trade that, in fact, they lost the most money. But it's so easy to actually mistake the process and the result, because let's face it, if you were short the stock market in February, it was just pure luck of the coronavirus that you, in fact, made a heap of money. So there's a great deal of luck required as well. What was my best trade? Well, the right answer to that is the best trade is the trade that I've made by following my rules perfectly. And I've got an example of one of those that I'll show you in a few minutes. I've made my best trade ever was in copper, and that was pure fluke, because what happened was that I was in South Africa, and I was long of the copper market, and the copper market dipped, and I was sure I'd been stopped out, and I came to London for the summer. That was it's years ago, and I came to London for the summer, and the broker, I can't name the broker. He's a London spread betting company. The only thing I can say about them is that their adverts are red. So maybe somebody will get an idea who they were. But I went to see the broker, and they invited me for a big, in those days, boozy lunches were quite common. Mm-hmm. So we went for a long lunch, and they talked about this wonderful trade that I'd had in copper. And I said, well, I got stopped out of that trade months ago. And they said, no, you weren't. So I'd missed the stop by a tick. And what happened is that copper had gone into this huge trend.
Oh, wow.
There was a massive amount of money sitting in the account that I knew nothing about. So that was, in terms of financial rewards, that was the best trade. And that's a long time ago. That was in 1999. I just remember now. That was in 1999 that happened. So in terms of cash, that was the best trade that I've ever made. But in terms of following the process, it in fact was a lousy trade. It was just a pure fluke. Okay, so one thing that I would like to advise everybody listening is that keep a trading journal. In that journal, do your best to try and differentiate between the process and the result, because many of the results that you think are favorable and get you all excited, in fact, occurred just by pure luck.
Spot on, David. I think it's the same mantra that we keep singing to all our clients too, which is separate the process from the result, but it takes some time for the mind to get accustomed to. But absolutely right stuff over there. And it's really great to see your input on the best trade, because most people would just say the best trade is the largest profit. In fact, actually, the best trade is the one that taught you the most, or like you say, the one where you just consistently executed the plan to the T and you saw the shift in your mindset. So really good for that insight that you shared.
Yeah, and I think that many of us are perfectionists as well. Many people come from the professions, for example.
Spot on, yes.
And they move into trading, and those, to be successful, and this is based on many, many years worth of experience of looking at retail traders, you need to, in my humble opinion, refocus that perfection into execution rather than the result. And if you focus your perfectionism into executing your simple set of rules over and over and over again, then the lift will take care of itself. So get really excited and get really worked up by following your rules to the tick, and keeping a careful journal. Those of you that would like a book on journaling, there's a beautiful book written by a lady called Julia Cameron on journaling. It's called The Artist's Way. In fact, she's just written quite a few books, so I think you would find that very good reading, anybody.
Okay, that's really good, Julia Cameron. Yeah, that's something that we can put into our trading library. Quick questions on stop losses. Do you use stops?
Yes.
Okay, great. I'm sure you're going to show us where you're going to use them and all that, right?
Yeah, I believe in tight stops, and the stop loss should be well out of the traffic, but it should be tight. And that's why, to do that, then your entry point needs to be brave at that danger point. So
very good point. Yes.
So you can both have you can have a stop that's relatively tight, and you can also have a stop that's well out of the traffic. When you actually have too much confirmation, then the stop has to be well out of the traffic, plus the amount of dollars or pips or whatever you're trading that has taken for the confirmation. So your stop has to, so the more confirmation you have to get away with the trade, your stop has got to be much, 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 much bigger. And because as sure as shooting, if you wait for the confirmation, a couple of bars, for example, before getting in. When you do get in, as sure as shooting, the damn thing will go right back, nail the lows, and then turn again. Has that ever happened to anybody else? So it requires a great deal of strength to get in at the right level and still to have the stop loss small and out of the traffic. And again, that testicular fortitude is required
Great stuff.
in big lumps.
I agree. Comes with time. I'm guessing you're going to show us all of that. How do you usually trail your stops, David? Is it a time stop, money stop, technical stop? Is it a combination?
Technical stops,
Technical stop mainly.
based on the chart. Yeah, based on the chart pattern. I want to risk 0.5 to 1%, and on the initial position, and I'll show you how I manage those in a minute.
So your risk manager is mainly based on percentage, right?
Yeah, that's right. I would 1% of the account in any one trade, and maximum, and then work out where the stop loss needs to be so that it's well out of the traffic, and then work out the bet size or the number of shares that I can buy so that if the damn thing falls apart, then I've lost 1% or less of my account, and then I move to the next one. I think that you can get away with 2%, but if you have a string of 5 bad ones, and you're risking 2%, and then you're down 10%, and you've got to say to yourself, can you come back from being down 10% without in fact doing something stupid? Certainly if you're working at a fund and you're down 10%, the risk manager will be giving you very long looks. He'll be saying, have we got a loose cannon on our hand here? So he'll be giving you some very, very long looks indeed. And you could find yourself in the back office stamping, or metaphorically stamping, share certificates, so that you don't want to go there. The trading floor, they have their Christmas party in Barbados. The middle office go to a hotel on Park Lane, and the back office, they have their Christmas party in front of a karaoke machine at Pizza Express. You just don't want to go to the back office, you know. So drawdown is difficult. And if you work for a fund and you start to run into 8 to 10% drawdown, then you're going to actually attract attention. So I would have thought at the institutional level, many traders are looking at 1/3% in any one trade. If they have 5 or 6 bad ones in a row, depending on their trading style, then that keeps that drawdown down. Some of the independent funds that don't, where they have managers that understand drawdown, run much higher levels of drawdown. And there are some books on trend following. There's a little book called The Little Book of Trend Following, and one of the guys in there says that in a pure trend following system, if you get a 50% return, expect to get a 50% drawdown during the same year. And that just would not be acceptable if you were managing client funds. That just would not be acceptable. All your clients would run for the door. Okay. So drawdown is hell. It causes you to do really, really simple things. So if you can't handle a 10% drawdown, then you need to be risking much less than 2% in any one trade.
I totally agree with you. That's the thing that hits the psychology. If there's one trade that taught you the biggest lesson, what would it be, David?
Well, in 1984, I had made quite a bit of money. In fact, quite a bit of money for my age, and I'd been in the markets at that stage about 2 or 3 years, and then in 1984, I got attached to one share on the Johannesburg Stock Exchange. I was sure it was going to go up, and I added to losers, and I gave back half the money that I'd made. And I had to, in fact, I remember vividly going outside Johannesburg, the South Africans will know a place called Magaliesberg. And I sat on a mountain out there and I meditated to make sure I would never do that again. So
Oh,
I think
wow.
the biggest takeaway from that, folks, is that never add to losers. Simple as that. Never add to losers.
Absolutely. Very nice. Very, very, very good lesson to learn from. Target questions. Do you have a predefined target for all your trades, or do you exit live, or do you
Well,
exit based on discretion? What is it?
well, it depends on a swing trade. No, but certainly, and certainly in the stock market, not. But certainly, I would look and be very, very aware of Fibonacci targets based on daily projections. For
So you
example,
don't put a target when you enter. You don't.
no, not, but I'm
All right.
aware
Got
of
you.
them.
Got you. Got you.
For example, today, the Australian dollar against the dollar went up and it stopped at a 78% retracement of the last range. And certainly that would have been a good place to have taken some profits in any longs. So I'm very aware of major Fibonacci levels on the daily chart and monitor those levels. And if I was up good money, and I was up in very good money long of the Aussie dollar, then that would have been a good place to have got out of the trade. I didn't, in fact, and I got out on a stop loss which was placed in the market. So I give a little bit back there, but it's not the end of the world.
So you either exit live or you either come out on a trail stop loss. Is that right?
Mostly on a trailing stop loss. Certainly
Mainly on. Okay.
certainly in the stock market, in swing trades in the stock market, on the trailing stop loss. But I am very aware of, on the Aussie dollar today, there's a particularly good example of a harmonic fib pattern known, given the name by one of my best friends, a big fella called Larry Pesavatis, as a Gartley 222, made famous by a chap called Harold McKinley Gartley about 100 years ago. That was in fact it called the Aussie dollar to the tick this morning. In fact,
Wow.
falling down. So I have a very good knowledge of harmonic patterns, and I'm very aware of the levels from those patterns. There's not many of them, but I'm very aware of the harmonic patterns. And
I'm sure you'll be very keen to see all of that on the chart. So let me just quickly go through this. Any quantified exit parameters that you have that you want to share with the audience, or not? Not particularly.
No, the fib patterns. I doubt if I can get through that in half an hour. But the fib patterns. If I was going to get out of a swing trade and I saw a major fib pattern, then if it was Friday, then I would be tempted to exit the position. I don't like to hold them over the weekend about a ham. So if I saw, for example, if the Aussie dollar had been pushing up towards that 78% level and it was Friday morning, I would have taken the profit then and there.
Got you.
It was early in the week, so I didn't. And in fact, I've been working hard at Vector Vest stuff recently, so I didn't actually see it. I mentor some students on the forex market, and one of the ladies, in fact, emailed me this morning in a real excitement. She says, "Is this a Gartley 222?" And
nice.
So she's in fact in the middle of reading Larry Pesavatis' book at the moment, so she got the Gartley spot on. Love my harmonic patterns. Not for everybody. Not for everybody, but they've been very, very good to me over the years. My very, very first public call, this was in South Africa, France, maybe you'll remember it. It was on Harmony Gold Mine, and Harmony Gold Mine had just charted a perfect butterfly pattern, and at 29 South African rands, and I called it in a live forum and on on business TV down there at 19, and in 6 weeks it went from 19 to 120 South African rands, and that was based on a butterfly pattern. And I got 1,000 questions. In those days they were in fact letters. How the hell did you do that? And that was just based on a harmonic pattern. There's lots and lots of stuff on the internet on harmonic patterns, folks. Not easy to get your mind around, but well worth making the effort. It takes a long time to be able to see them easily.
David, a very quick question, a yes or no question. Do you scale out on your trades?
Depending on the market itself, uh, in the stock market, we had a situation prior to this sell-off where the stock market itself was going nowhere for 2 or 3 years. It was stuck in a trading range, and in that period, I found in the stock market that it was useful to scale out of positions. Yes. So
Right. Okay.
if I see that the market is stuck in a range, then I would be tempted to scale out of positions, and that's in fact what I recommended to new people. Now, there are the old question: do you scale into positions or do you scale out of positions? There's no answer to it, because I know many people that are exceptionally successful, and one of them scales in, the other one scales out. I think that if you've got the stomach for it, adding to winning positions makes much more money, but it's just so much more difficult to do, because you buy a share at £10, it goes to 12, and the chap who scales out, he takes off half, gets a stop to entry, lets the other half run. And maybe he'll get a runner in the second half, but if it falls apart at 12, at least he's put £2 in his pocket for half the position. So he goes to bed happy, and he's content. He's been right, which is probably more important than the money. Whereas the chap who's adding to the position, he adds to the position at 12 and the whole thing falls apart. And he goes to bed kicking the dog. So it's just so much more difficult to do. So certainly for new vector-based people, brand new vector-based people, until they get a feel, I actually asked them to scale out of positions, especially in the market that we had that was stuck in a range.
See, David, I totally agree with you on that, because even on our live trading sessions that we do, we advocate actually scaling out, because you see, at the end of the day, like you nicely pointed out, you want to go to bit content, and that's what gives you the psychological strength to keep going forward, is it not?
Well, that's correct. There's no doubt that scaling out is much easier to do. You feel good. When you feel good, the whole process, in fact, grows.
Beautiful, absolutely.
But it also means that when you're wrong with a full position. And
Yes,
when you're right, you're only right with half a position or less.
yes.
And mathematically, that is not as good. But nevertheless, both methodologies can be used exceptionally successfully. If you scale out, okay, and for new people at VectorVest, I recommend that if you buy a share at £10 and you put the stop loss at 8.50, when you've made as much as you've risked, in other words, the share has gone to 11.50, bank half, get your stop to entry, and then let the other half run. Now, the methodology is successful and profitable only if you've got the testicular fortitude to actually have a very loose stop or no stop at all on the second half. Okay, and that's what I try and get across. So the scaling out is only profitable if you can keep your sweaty little hands off the second half. Get your stop to entry, and then have a very loose or hardly any stop at all on the second half. If you chicken out of the second half too quick, and you don't get that 30% that are going to be big runners, then it's not a profitable strategy at all.
Absolutely makes sense, because the math's got to work as well. You're absolutely right. The final question, which actually was inspired by in the New Market Visits book, which is actually a litmus test to our system and our execution, is this question. So, and I want to ask you that. I mean, do you feel at peace when you exit most of your trades? Like you said, do you feel content, or do you regret sometimes for coming out early or late?
Yeah, sometimes you get out on a Friday and the thing gaps your way, gaps further on the Monday morning, and you say to yourself, well, why didn't I hold the bloody thing over the weekend? But no, I don't get upset about that anymore. I just shrug my shoulders and move on and look for the next trade. I get upset if I make a mistake. I make an obvious mistake. And maybe I should have seen that 78% level in the Aussie dollar this morning. Maybe that was an obvious mistake because I wasn't working hard enough. I had webcasts and videos to do. I should have maybe seen that. So, but no, I don't get upset about things, especially if the market does something silly. I get upset when I don't follow my rules. That doesn't happen that often, but it does happen. It does happen.
That's brilliant, David, because I think that's the mark when all the traders start to see that they are really improving and growing when they're at peace in following the system rather than, just jumping in without a system or a plan. And then, of course, then this regretfulness or this, sometimes getting greedy just to stay in a bit more starts to happen. So that's definitely the mark when we can start to see that we are really growing and we are, as a professional trader. In terms of psychology, just one quick question I want to ask you before we go onto the screens is, do you do any kind of practice to work on your mind for consistent execution?
Yeah, it's called the gymnasium.
All right, okay.
And it's bloody well closed at the minute. Which is a real pain in the arse. But I'm doing my press-ups and planks and doing lots of walks on Hampstead Heath. So I'm trying to keep fit like that, but I miss the gym terribly. I normally go twice a day. Go at 6:30 in the morning, and well, I've been a bit slack this year, but 6:30 in the morning, and then about 5-6 o'clock in the evening for a second go. So without the gym, I don't trade nearly as well. So that's about all I do, but I'm certainly very aware of when I'm not up for it. And I've been at this long enough to know if somebody has upset me, for example, and I know I'm not up for it, just to leave it alone. So I think it's important that you can observe your own thoughts and just be totally honest with yourself if you're not feeling good. Okay. So
for those of you not seen David, I mean, he's as fit as a young 18-year-old lad.
Yeah,
and he can outbeat you in any run. I can tell you that.
I wish. I'll be 65 in a week or two.
You definitely don't look like it, David. You're very, very strong and healthy. I can tell you that.
65.
I think now we can move on to the practical session, David. I know we are quite a bit tight on time, but if you can just show us just a little bit, like for 10 minutes.
Okay.
For 10 minutes, and then we can also then, for those of you on the Learn More, we'll tell you the places you can go to find out more about David. I will just let you share the screen. I'll stop my share.
What I do now, share screen.
Yes, that's right. And then I'm sure the audience will be able to see it. And then for the last 5-10 minutes, guys, we can also open up the floor for Q&A if you got any questions. In fact, all your questions that you got so far, as David is preparing his screens, you can just type it in, and we can look into it later and we can read it out. We can pick.
Can you see my screen now?
I can see your screen. Let's see if the audience can see it all. Okay. Can you all see it all fine? Yes.
You can see the blue screen, Master of Markets Trader interview.
Yes. Okay. And also the clients are able to see it as well. So let's go on with it. Yeah, come on.
Okay. The first thing I got to put up, folks, is the disclaimer. VictorVest, I think, pretty much the only training organization in the stock market in the UK that's authorized by the regulator. So although I may speak about shares in a moment that I hold myself, I have to make it very clear that although those are suitable for me, they may not be suitable for you. And certainly leverage positions in the stock market I have to warn you about. So what I do, folks, is that I do some intraday trading, not as much as I used to, of mostly the Dow in the afternoon, or what the spread bettors call Wall Street, and some forex pairs. I rarely intraday trading, look much further than the cable. That's pound against the dollar, the euro dollar, and the Aussie against the dollar. Swing trades, looking for opportunities, 3 to 21 days in UK, US stocks, forex pairs, gold, oil, and US treasuries. And then this is the sort of portfolio that I talk about at our VectorVest Q&A meetings, which are core trades and stocks that last 2 to 6 months. And then I have, because I'm 65, I've got a portfolio focusing on yield as well. So, and I believe we need 3 things, folks. We need a method. And for me, that's a fusion of VectorVest and the Wyckoff, a technical analyst by the name of Richard Wyckoff, low risk setups. We need to manage our money really well. And that we talked about a few minutes ago. The clusters are absolute hell. If you have 3 bad ones in a row and you're betting 5% of your account in any one trade, you're down 15%, and 15% will start to rattle you. And if you work for a fund manager, you'd be out in your ear. And of course, we've got to manage yourself really, really, really well. And the things that show us how to make some money are risk to reward, how much money you make when you're right, how many times out of 10 you are right, and then of course commissions and spreads. And in stocks in the UK, we have to pay stamp duty as well. So that's the whole concept of expectancy. And expectancy simply means that your system must make more when it's right than it loses when it's wrong. And that's a word that's been sort of stolen from the gambling industry, expectancy, because the casinos have worked out the expectancy of the casino games. And the casinos, as you would imagine, have written a set of rules for all the casino games, which means that they make much more than they lose. And they built cities on it. The dude putting the £1 coins into the machine has got a negative expectancy system. The longer he stays, the more broke he becomes. So this is something you may have worked out on your own. And the discipline is summed up by Mike Tyson. You know, everybody's got a plan until they get a punch in the mouth. Okay. And Thiru asked me, in the morning. This is something that I think about in the morning every day. It was a wonderful movie. It got an Oscar for Clint Eastwood and Hilary Swank. It was called $1 Million Baby. It was a boxing movie.
Yeah, it's a good movie. I've seen that one.
Clint Eastwood ran this gym, and he didn't like female boxers in the gym, and he gave her that long Clint Eastwood stare. And he looked at her and he said, "Are you working the bag, or is the bag working you?" So that's a good question to ask yourself every morning, folks. Are you working the bag, or is the bag working you? So what I do in any market, the setup involves establishing trades at the danger point, where the risk is least and the profit potential is greatest. Now, I took that out of Richard Wyckoff's little book that he wrote in 1930. But I have 4 theories. I don't know what you think of these guiding thoughts. G-U-I, did I spell that right? Guiding thoughts. First one is the good trade is a hard trade. Now, this does not mean that it has to be difficult. It just means that it's difficult emotionally to execute. You don't have to be that bright. In fact, I think probably the thicker you are, the better. The good trade is the hard trade. Thought number 2, I fade the short-term trend in the direction of the long-term trend. So if I get my little pen out, if we've got a long-term trend, series of rising bottoms, I want to fade this little bit. Okay, that's the short-term trend. This is the long-term trend. On VectorVest, we have we actually put a word to the trend 2 words to the trend every day: short-term and the long-term trend. I fade the short-term trend in the direction of the long-term trend. Thought number 3. This will revolutionize your trading. I place my entries where the masses place their stops. Okay, think about that. I place my entries where the masses place their stops. And thought number 4, I am correct with big positions and wrong with tiny positions. And that's all about adding to winners. Now, there's no doubt that that is difficult, and I have no problems if you scale out. But folks, if you do scale out, the half that you hold, get your stop to entry, and you need to let that half run. If you don't let that half run with the stop at entry with a very tight trailing stop loss, that scaling out is not a winning proposition. Now, if you want to make big money, you've got to get to the point where you can add to winners. And both myself and my trading partner, a big fella called Tom Hogarth, we've proved this over and over and over and over again. And that's what we do. So Mr. Wyckoff says that you can make a fortune trading springs, upthrusts, and sweet spots. They are the cornerstone of the Wyckoff method. Again, I take that out of his book. And as I've said in the preamble, adding the VectorVest fundamentals in the stock market and the direction of the overall market pushes the hit rate up markedly and also pushes the risk to reward up markedly. So the stock market, I firmly believe, is easier because of that reason. Now, there's no easy money anywhere, but nevertheless, I think the stock market is easier. So what are we looking at? We're looking at, to find a trend, a series of rising bottoms, and you all know you can put a trend line on there. There are three types of trends according to Charles Dow. And Charles Dow said that if you have a higher low, and that higher low is higher than this last top, this higher high. In other words, there's a gap in here. It doesn't come back. Again, call that a positive break. Then you've now got a fast trend, folks. And in a fast trend where that bottom is higher than that top, that's the only place where I actually use breakouts. So if I see a fast trend and the market, in fact, doesn't break, doesn't come back to that last top, then it's okay to actually buy a breakout, or it's okay to add to a position in a fast trend. Now, that's the second type of trend is what Dow called a normal trend. And the normal trend happens most of the time where the market comes back to that last old top. Now, why does it happen? Well, folks, you're going to have to read up on behavioral finance for that, because it's called a recency bias. And the behavioral finance chaps have got long hours to kill in universities. So they've come up with many thousands of terms to actually try and put a handle on what we do. It keeps them off the drink until a respectable hour, I suppose. So markets come back to that last old top, and that, folks, is a very good place to enter somewhere down around here. And that's what Wyckoff called a sweet spot. I use it all the time. Now, you'll be saying out there, well, everybody knows that. But folks, I assure you that it's quite difficult to do. Because when the market is pulling back, everything in your head is saying, hey, this is not a pullback at all. This is a change in trend. So it takes a little bit of, again, testicular fortitude to do it. And then, of course, the last type of trend that Dow talked about is what he called a creeping trend, where this low impinges on this high. And that is either a reversal or the market going into a consolidation. So when you see this, you need to be careful. So I want to be trading in markets, trying to make a buck in markets where I see a fast trend or a normal trend. When I see a creeping trend, time to be careful. It could certainly break up again, but stay in the moment and do your best to avoid that. Now, volume is great, and I've spent a big part of my life looking at volume, and I could spend 3 days talking about volume and a thing called market profile. I don't know if you guys have used market profile, but it's just another way of looking at volume. But pullback should happen on falling volume. Simple as that. And I've got this is out of Wyckoff's book. I've had an artist add the color because it was in black and white. But if you do trade a breakout, folks, that breakout should occur on rising volume, and it should pull back on falling volume. And you want to buy there at the danger point. So let's have a look. That's a sweet spot. simple pullback to here. And I'll define that and show you some examples of that in a minute. And really, for the sweet spot, I'm looking for a entry point somewhere down around there. And this chart, France and South Africa, I think that is Harmony Gold Mine, actually. The chart is really, really, really old. Harmony doesn't exist anymore. It's a part of Sibanya, I think. So this pulled back to this area, and then it started to move up the page. The Fibonacci people would call this A, B, C, and D. Any harmonic pattern people watching?
David, just a very quick question on that our traders in the room would be interested in. You know the part where you're saying that it falls back to the resistance point where you've drawn, which is C, right?
Yeah.
Our guys usually be interested in how do you quantify that thing consistently where you have drawn the high part, the resistance where it drops to? Or is it just based on discretion that you find that high part where it comes back to in C?
Yeah, just draw a line.
Okay, that's what you. Okay, right,
draw a line.
Right.
And just draw a line. And there's fib in there as well. We'll talk about the fib in a minute. This is a UK share called Lion Trust Asset Management. And last year, we bought our first position into it at 780 down here. It went up and it pulled back into this range. And I added to it here. And I added to it there and let it run up the page. I could have added to it here as well, but I didn't. Okay, so I bought my first tranche there, second tranche there, third tranche there. I was right, and I was right with 3 times as much as I would have been wrong with. And I used these pullbacks to the last old high to add to the position. No more complicated than that. So that's Avon Rubber. Again, in the UK market, we've got earnings per share rising, and it broke, came back. You don't have to buy the level, but I normally do simply buy the level. It broke, came back to here again, and away it goes. So again, from the initial position, 3 times bigger as it moves up. That's simply a sweet spot. That was a short in a US company called Helen of Troy. And I think it's useful to put on moving averages. We want to buy the sweet spots with the moving average. That was a buy signal just there. I didn't get it at the level, but there was a big outside bar there. And it pulled back to that old top, and away it went. And then all of a sudden, in the sell-off, it went up and it kissed that low. It printed this red day, and it was a nice short there. Okay, I'd been stopped out of that, but good profit in it to start with. So very simple. Now the second and most useful Wyckoff technique is the upthrust and the spring, and I use this more than anything else. And let's look at the buy signal for a second. The objective of this, folks, is to find a trend and then to use these to get into the trend with virtually no risk, and then add as it moves. I'll show you examples of it in a second. We get resistance, which becomes support. It then breaks up, and that would be a sweet spot. It breaks up, can't make a new high, and then it goes back and takes out that low and then reverses. And that's the spring. And the upthrust is the mirror image of that. Support, resistance, can't make a new low, goes up, takes that top out, runs the stops, and then comes down. Now, this is not called a spring for nothing. When it goes, it goes. It is my favorite setup, and I use it all the time. That is, I can't remember what it is. It's the cable. And there is the cable. Now, it's an hourly chart, and there's no doubt that I also look at the daily chart for long-term trends using Fibonacci, but that's beyond the scope of this talk. But in terms of trend direction, I've been using an 89-day moving average for as long as I can remember. And if on the hourly chart, if the price is above 89-day, then it's good. Those of you that are share traders, if the daily chart on the share price on VectorVest is above an 89-day moving average, all is good. Now, there's resistance, comes back once, can't make a new high, comes back, takes that level out and reverses. That was the entry, or you could have bought the level itself, and that was the first entry into that cable long after this turn. And I added to it quite a few times up the page. I added just there. That was a sweet spot. Okay, so add it into this position as it goes my way. Now, you could trade this as an intraday trader, take a few points and leave. But the real trick is to get in, let the trend develop, then get in, and you're getting in with this amount of risk, and then let it run. Now, you're getting in with this amount of risk again, let it run. So building a position, when I'm right, I want to be right with a huge position. When I'm wrong, I want to be wrong with a tiny position. And I have no problems admitting it might take you a day or two to see these. I don't know, they say the first 20 years is the worst, but after that, you can see them easily. Once you've trained yourself to see these, you'll never look back.
David, you know, just a quick one, just to stop you. That just aware of time as well, because we said it's up to 1:30. Whatever it is, maybe you can. It's really interesting here. I think you should maybe just finish off what you are saying, and also we can give them a link where they can find out more about this as well.
Yeah, well, there's not much to it than this. This is the Aussie, and there's resistance. It pulls back. I should have got that. I'll show you in a moment. I should have got that, but I didn't. I don't think I did. And it then breaks, comes back, kisses that, goes up, can't make a new high, comes back down, takes that level out, springs. And that's the setup. There was the risk. That's the reward. Okay. And I haven't been able to be profitable any other way. One has to be brave. Now, as you'll see in a moment, we could have been in down here as well. There was a lovely little candle pattern. It's called a multiple inside pattern here, which is rarely lets you down. Now, that is the dollar against the Japanese yen, and that is as of a few moments ago. I was waiting for an upthrust here. I was waiting. There's that support goes up once, can't make a new low, and I was waiting for this to go up here, and it didn't. But then it charted an outside bar, so I thought I would have a go anyway, and it moved down the page very nicely. Now, on the daily chart of the dollar against the yen, there's a very powerful daily low down here. But that's the sweet spot. It went up, kissed that old low, and I'm short of that at the minute. We shall see. Those of you that use the stochastic will see the stochastic also showing reverse divergence. So initial position there, and I had an order in here, just here, because there was another upthrust just there. But the damn thing didn't give me the fill before falling, but this one did. All right. So I should be 3 times bigger, but at the minute I'm only twice as big on that particular position. That again is the Aussie. That's the trade we talked about a moment ago. And I added there, and then all of a sudden it fell out of bed. Now, you might see that I have that I'm looking, this has gone down a little bit further since I did this, but I would expect this to rally overnight up to here somewhere, and tomorrow morning, if I see a short there, then I'll be shorting it up there, just simply under that low and that high. Very powerful level. So nothing much more to it than that. There is the Aussie again. First position was there. That was the first entry. I should have been long there, because as you can see, there is a old high there. Should have been long there, but didn't. That's the spring, and managed to get in there again. So that was the first, that was the second, that was the third. 3 times as big, and got stopped out under that low last night, somewhere in there. Should have seen the 78.6 right at the top, but didn't. Looking for a short on the Aussie against the dollar tomorrow morning, but I'm not going to short it now. The market is in fact trying to seduce me to go short at the lows of the day, and then it will promptly go up and stop me out. So no way, I've been around the block too long for that. That's the spring. in a share. Okay, I just want now to go into the stock market and have a last little look at some shares in the stock market. And this is a longer term stuff, but these are stocks that I've held, and I've spoken about them on Monday afternoons. This is a weekly chart. That's the price. Down below the price is earnings.
David, I think we can't see your screen, the one that you're showing at the moment, the weekly one.
I wonder why that is now.
I think you did that the last time. I think it's probably because the screen that you're sharing.
Oh, I don't know what's up then. I have no idea.
Can you minimize this one and bring it to the screen, or?
I'm only using one. It says my screen sharing is paused.
Okay, maybe stop it and share it again. Maybe that will work. And put the vector west thing, whatever you're showing on the chart. We still can't see it. Yeah, there you. No, that's the
that's
PowerPoint.
The PowerPoint. Slide. Okay. Can you see it now?
No, it's not coming up.
Okay.
So when you share, it will tell you which screen you're sharing.
Okay,
so maybe choose the.
All right. Yeah. Okay. That's. Is that it?
Brilliant, brilliant. We can see it now.
Okay, I'm not that good at this contraption. That's Avon Rubber. Now, the reason I'm looking at this share is that it's got a very high. At the moment, I've advised all VectorVest customers to err on the side of caution and to only look at shares with outstanding fundamentals. And on VectorVest, we have a metric called relative safety, which finds shares that have outstanding balance sheets, income, cash flow, and lots of cash to handle a downturn. Daily Telegraph this morning can't make its mind up as to whether the GDP contraction is going to be the worst since 1905 or 1720. Okay. And that's the front page of the Daily Telegraph this morning, and I may have got 1720 wrong. It might be 1730, but it's one hell of a long time ago. This market, that's a sweet spot. The market came back to there. Now, I didn't get that. As you can see, earnings per share growing really strongly indeed. That would have been a cracking level. As you can see, we got an old high, and the darn thing comes back to that old high. That would have been a great place to have got in. I didn't, but got in this, and I've been speaking about this for the last few weeks. Now, this is polymetal. This is just textbook stuff. We get earnings per share is okay. It's a gold mine. Simple trend line. And if we draw in a fib from that low to that high, we can see that that was 61% of it to the tick. So we've got the trend line and the fib confluence, and the market just bounced off that and goes still very strongly indeed. So this Lion Trust Asset Management been a great player for us, and we've got this. There's earnings per share, and we've got the old top. We've got the trend line, and we've got fib all coming in together. If you were doing a textbook on technical analysis, that should be there. And this is what VectorVest is all about, to try and find shares with impeccable fundamentals, and then to give you the skills to get into them at an exceptionally good level. And I'm long of Lion Trust Asset Management from under £8 here. So that's quite good. This is Games Workshop. This is the share that I talked about. I was laughed at, openly laughed at by guys at the Traders Show. And there's the trend line. There's earnings per share. And there's the old top. That's the sweet spot. And there's the 78% retracement. Those of you watching, folks, or listening, 78 is the square root of 618. It's an incredibly important Fibonacci number. And if you come to my Monday afternoon meetings, you'll be listening to 78, because it's one of my favorite numbers, especially in the forex market. The forex market vibrates. So looking for a trend, and we're looking for one. The good trade is the hard trade. It didn't take any great intelligence to buy that market down there, did it? But it took a great deal of testicular fortitude to do it, I assure you. So the good trade is the hard trade. I fade. There's the long-term trend. I fade the short-term trend in the direction of the long-term trend. I put my entries where the masses put their stops. And I want to, in fact, to be right with many more shares than I'm wrong with. Now, I haven't actually added to this position as yet. My own feel is that the stock market needs to pull back a little bit first. The Daily Telegraph didn't give me a great deal of confidence today. That's JD Sports. Many people say they're not going to sell many shoes over the next week or two, but they sell a lot online. Earnings per share is impeccable. Came off these lows. We shall see. That's the GB Group. Again, you can see the theme here. Earnings per share, great. Support, 78% retracement, and it bounced off. That was incredibly noisy in there. It's been in a crazy period. That's Diploma doing the same thing. And those are some of the shares that I'm holding at the minute, folks. Shares with outstanding fundamentals, which Victor Vest finds automatically. If I go to our viewers page, the stock viewer, and I resort by our metric relative safety. It brings those shares, well, when the internet is playing the game. Clearly this thing is Zoom contraptions taking a great deal of bandwidth. When I, in fact, click by relative safety, it brings those shares with the best balance sheets to the top of the list, and that's clearly not going to work. This Zoom must take a great deal.
I think that's fine, David. I'm sure the viewers are getting a really great idea. I'm just aware of time. You're just about 10 minutes past. I mean, do you have a little bit more to show? Do you have the last 2 minutes, 3 minutes you can summarize?
Yeah, well, I just want to do those. Very strange that those viewers it doesn't want to do that for some reason. That's a function of the internet. If I
now it is, yeah.
There we are. What I've done is I've resorted all of the shares in the market by relative safety, and that's bringing Avon Rubber, Lion Trust, Games Workshop, Porvair, Cranswick, a great company. Crichton's makes hand cleaning stuff that's used by the NHS. It brings these shares with impeccable balance sheets to the top of the pile. And folks, that's where we want to be focusing, in my humble opinion, because over the next few weeks, when we come out of this nightmare, my grandfather told me a very long time ago that the objective of a recession is to get through it, and companies that can get through it with cash will be able to pick up bargains for next to nothing. I like the look of Berkeley, the house builder, the London house builder, run by a chap I know reasonably well called Tony Pidgley, and he's got £1 billion sitting, and in 2007 and 2008 he also was in a very cash plus position, and he managed to go out and buy enough land at knockdown prices to keep them building for 10 years, and my contacts tell me he's doing exactly the same thing at the moment. So companies that have the cash to come through this will do exceptionally well. In the US, I have a watch list called Cash-Laden Tech Giants, and for example, Microsoft has got 146 billion. It's got a very high relative safety number, $146 billion sitting waiting for acquisitions, and Warren Buffett isn't nearly. Warren Buffett's got 105 billion waiting on to make acquisitions. So Apple's pretty much in the same place as well. So those companies will be able to buy things at knockdown prices in a week or two. All those CEOs that spent all their cash buying back shares must be having a very poor night's sleep presently. So cash will be king for listed stock markets, and ladies and gentlemen, cash will be king for all of us until we come through this nightmare. I think the main thing is to take care of ourselves, and as Boris says, to keep washing our hands every few minutes.
David, you're absolutely right, and I think that can bring us to a wrap. That incredible information that we shared, because we started from your background and the theory, and you showed us on the screens how we can actually use all that theory to practice on the screens to capture the moves that are happening. So you can really see that the theory is working in real time, and I think that is the purpose of Trader Stock webinars, to show you real traders who are making real profits in real time with consistent performance. David, if the audience want to find out more about you, where is the best place to go so that I can put it into the chat box here?
vectorvest.co.uk, and for the pricely sum of £5.95, they get everything. That's a 30-day trial to VectorVest, and if you
vectorvest.co.uk, is that right?
Yeah, and you get the VectorVest program for 30 days, and you get all my webcasts for 30 days, plus my colleagues' webcasts. We have a little course on VectorVest. If you go to training, there is a 5-part course that will actually show you how to go about building wealth in the stock market.
Do you have a link to that, or is all on vectorvest.co.uk?
It's all on vectorvest.co.uk. If you go there, you can, there's a big box that says take a trial. The trial's £5.95. And if you think, if you try it and you like us, then VectorVest, £49 a month. It's on a month-by-month basis. My promise to you is that if we can't show you how to make money in the stock market, then you can stop it.
Actually, let me bring it on my screen so that the viewers will know where to go. So it's this one here, right, David?
Yeah, look at that good-looking fella.
All right, there you go. That's David there. Right. So
fellow.
So where do they go to register? Is it
risk-free trial?
Over here, guys, right?
Risk-free trial,
and that's it. And then you can carry on with that.
It's a fiver. It's a fiver.
So I would say it's really priceless. You can get all the information, and of course, for David Paul today itself was very priceless. And I think that's pretty much that for today, folks, and also for all of you who attended. To reward you all, you also give you free material as well, so that you can learn a bit more about the financial markets and a systematic way of trading. But definitely do check out David Paul's VectorVest page. Thank you so much for your time today, Paul. It's been a pleasure.
Oh, it's a pleasure to be here, sir. And I'm sure I'll see you at a trading show in the near future when they get back running again. I see Master Investor has been postponed to December.
Yes.
And the other show that we were going to go to, Mellow, has been postponed to September as well. So there'll be a flurry of them towards the end of the year. So as long as everybody stays safe and take care of ourselves, it's a
Exactly. And thank you so much for your time. Thank you to everyone for coming today, and always towards the truth of trading. Till the next time, stay disciplined, follow your trading plan, and keep trading like a master. Thank you, everyone.
Cheers, everyone. Bye-bye.
Thank you.